Hello and welcome to the channel. My name is Amor De Libasic and I'm a licensed financial advisor, and today we're going to explore the world of self-managed super funds, or SMSFs, with a particular focus on how you can purchase a property inside of one. We're going to talk about the rules you need to follow, the differences between individual and corporate trustees, and the advantages and disadvantages of this approach, as well as who an SMSF might be appropriate for. By the end of this video, you should have a clearer understanding of whether this strategy could be right for you. First, let's define what a self-managed superannuation fund is. In Australia, superannuation is a way for saving for retirement, with contributions made by employers or individuals. Most people leave their superannuation in a retail or industry fund where third parties manage their investments. However, some people decide to set up and manage their own superannuation fund. This is what we call an SMSF. An SMSF can have up to 6 members, and each member is generally involved in decision making. They think about how the fund's money is going to be invested and what the overall investment strategy is going to be. That said, every decision must comply with the rules set out by the ATO and has to be consistent with the sole purpose test, meaning the fund exists solely to provide retirement benefits to members or to their beneficiaries in the event of their passing. One of the first choices you face when establishing an SMSF is whether you should have an individual trustee or a corporate trustee. With individual trustees, each member of the fund is listed as a trustee in their own name. This can be cheaper to set up initially because you don't have to establish a separate company, but it can create more paperwork later. If someone leaves the fund or a new member joins, you'll need to adjust the names on asset titles, re-register documents, and update the ATO. By contrast, a corporate trustee involves setting up a special company that acts as the trustee for the SMSF. Each member is a director of that company. Now, although there are fees for setting up and maintaining a company, the administrative process tends to be smoother if members come and go in the future. You simply update the directors on the company rather than having to update the names on all underlying assets in the fund. Many professionals do recommend a corporate trustee for long-term flexibility, and it can assist in other structures if you're going to borrow inside of the superannuation, but the right choice ultimately depends on the goals, budget, and willingness to handle certain administrative requirements within the trustees. Before we get to the property side of things, let's outline some fundamental rules of an SMSF. Perhaps the most important principle is the sole purpose test. Now, every transaction made by the fund must be for the sole purpose of providing retirement benefits to members. This means you cannot use the SMSF for personal gain before retirement. For example, taking a holiday, utilizing fund money, or purchasing an asset you enjoy right now would be a contravention of the rules. You also need a formal, written investment strategy that sets out your fund's objectives, risk profile, and planned asset allocation. Now, this strategy should be reviewed regularly to ensure it continues to meet your retirement goals. On top of that, the ATO does require that you have your SMSF independently audited each year and to lodge annual returns. Good record keeping and strict compliance are essential to avoid penalties. Remember, the SMSF can have up to 6 members at most. However, most funds have fewer. The more members you have, the more viewpoints you have to juggle, and the more complex your record keeping will become. So now let's focus on buying property inside of an SMSF. Most Australians find property appealing because of the potential for steady income and the potential for long-term growth. Combining that with superannuation's tax advantages can be a really powerful approach. However, it is important to remember that property is typically a large and fairly illiquid investment, and so you should only move forward if you only truly understand the mechanics. To make a property purchase, the fund must at least have enough money to cover the deposit, any related purchase costs like stamp duty and legal fees, and still maintain a level of diversification. It's usually not wise to sink every dollar of your superannuation balance into a single property because that can leave your fund with limited liquidity if other needs arise, such as paying a member's benefit. Now, you can purchase a property outright with the SMSF's existing funds, or you can borrow utilizing a special arrangement called a Limited Recourse Borrowing Arrangement, or LRBA. An LRBA allows an SMSF to take out a loan, where the lender's recourse is limited to the property itself, meaning if things go wrong, the lender cannot seize any other asset of the SMSF. If you borrow to buy a property, you must set up a bare trust, also known as a holding trust, to hold the property until the funds have been repaid on the loan and the property can be moved into the SMSF. Although this structure can reduce risk for the other assets in the SMSF, it adds complexity and costs in terms of legal and setup fees. It's also worth noting that the property cannot be lived in or rented by a member or a related party unless it qualifies as business real property like a warehouse or an office your own business might lease back at market rates. Even then, all transactions must be done at arm's length to comply with the regulations. This means you cannot give favorable terms or favorable rents to yourself. Many people see advantages in utilizing an SMSF to purchase property. One key advantage is control. You have a direct say in how your superannuation is invested. If you strongly believe in real estate, an SMSF lets you act on that conviction. Another advantage is tax. Earning inside super is taxed at a rate of up to 15% in the accumulation phase. This is often lower than an individual's marginal tax rate. If the property is held for more than 12 months, within the SMSF, capital gains are effectively taxed at up to 10% in accumulation stage. Once you move from accumulation into retirement phase, rental income and capital gains in a full account-based pension are taxed at 0%. This means that if you were to buy a $500,000 property and then 20 years later, when you were in retirement phase and in a full account-based pension, sold it for $2 million, there would be absolutely no capital gains tax payable at all. There's also the possibility of leveraging inside an SMSF, which can amplify gains if the property performs well. Additionally, if the property is your business premises, you could pay rent to your own SMSF, potentially turning what would have been an expense into a way of pushing towards retirement savings. On the flip side, there are definite disadvantages to an SMSF. The setup and ongoing administration cost for an SMSF can be substantial, especially if you incorporate a borrowing arrangement. You also have to consider the lack of liquidity and diversification that arises if your fund invests a big chunk in one large asset like a property. If the property market suffers a downturn, or you need to release funds for a member who's retiring, you could face difficulties. There are also strict regulations that, if breached, can result in incurring severe penalties, up to losing 47% of the value of the fund. Borrowing further magnifies the upside and downside of any investment. If your property underperforms or you struggle to meet mortgage repayments, this can negatively impact your overall retirement balance and retirement prospects. Now, considering all of these factors, who might an SMSF and SMSF property strategy be suitable for? Well, people who already have a relatively large superannuation balance of at least approximately $300,000 or so are the best candidates because they have enough funds to manage the costs and maintain some degree of diversification. It can also be attractive to business owners wanting to purchase their own commercial property through their super for stability and tax benefits. Individuals comfortable with hands-on investing and administration may thrive in an SMSF environment because they appreciate the control and are willing to handle the complexity. It's also not a good fit for people who want a set and forget approach to super. Running an SMSF involves responsibilities like annual audits, investment decisions, compliance checks, and detailed record keeping. If you plan to make substantial withdrawals or require flexibility in the near term, tying up funds in illiquid assets like real estate could limit your options and represent problems in your future. Ultimately, whether you buy property in an SMSF and whether this is the right decision for you comes down to your risk tolerance, your long-term objectives, and willingness to manage a more complex superannuation structure. While it can be highly rewarding if done correctly, it's certainly not without challenges or pitfalls. It's always wise to speak to a financial advisor, accountant, and SMSF professional when looking at an SMSF strategy to ensure it's the right thing for you and you're on the best path forward relative to the goals that you have. As always, if you've enjoyed this video, please like, comment, and subscribe. If you have any questions or topic areas that you're interested in, leave them in the topics. I'll try and get to them all as quickly as I can. As always, thank you and see you later.